Yeah.
Okay, let's begin. So today we'll hopefully finish the GDP. So that's the last 2 or 3 topics that we have to discuss related to this concept. What we're going to be doing is number 1, after having finished this expenditure model, how to compute, how to calculate GDP. We're going to explore briefly now an alternative. Okay. An alternative method of computing GDP, which is called the income method. Of calculating GDP. I'm going to say something about the difference between nominal and real GDP. Nominal versus real GDP. And finally, some additional definitions pertaining to probable business cycle. Definitions of business cycles. Some definitions. Definitions of the terms. Okay, first, the income method. I'll just remind you that last time we said that it doesn't matter how you calculate GDP, that you can think of gross domestic product in a certain sense as the value of all market transactions with final goods and services. This example, if I buy a cup of coffee from you, that means for $5, the value of that transaction is $5. So it doesn't matter whether you treat a transaction as buying, from my point of view, or as receiving it from the point of view of itself. The value is the same. It's a cup of coffee worth $5. Doesn't matter how you calculate it. So then just apply that to all final goods and services, to the entire economy as a whole, and you get the same equation, the same fundamental equation that the spending has to equal income. These are just the 2 sides of the same transaction. Total spending in an economy equals total income. As simple as that. So now, what is the structure of income? What are the individual elements of income? So there are some interesting graphs that could be drawn to demonstrate this. One of the simplest models for studying the income and spending streams in the economy that can demonstrate the relationship between spending and income is something called the circular flow diagram that describes the relationship, how money and resources are moving around in the economy between firms and households. You see that one moment is the spending, another one is the income. Let's assume that here are the households, here are the firms. So firms produce final goods and services. So you have 2 flows. The flow of resources and flow of money. So let's start with the flow of resources. Households provide the resources to firms. What are those resources? Those resources are land, capital, labor. Land, the natural resources, capital goods, machinery, equipment, or savings that are necessary for the firms to accumulate money that they can use to buy invested goods, and labor services, before providing services of labor to the firms. So that's the first step in the circular evolved economy. So then firms receive those resources, combine them and produce eventually final goods. So they trade among themselves, buying and selling intermediate goods, but eventually once the final goods are made, they're sold back to households. Those would be final goods. So that's how resources move from households to firms and back to firms, and households buy final consumer goods from firms. The opposite flow is the compensation for both those sources. So households provide labor, capital, and land. The firms, what they get in exchange? In exchange, they get incomes. Which are rents, compensation for natural resources, and also you can say for real estate services. So for capital goods, profits, and interest. Or when you buy a stock in a corporation as an individual person living in a household, you're providing money. In exchange, you get profits or dividends. Or when you put the money in a bank channels eventually your savings into producer loans, firms, and then firms, or the bank pays you net interest on your income. And rents. Finally, for labor, what is the income that accrues to labor? That is that people get in the exchange for their labor services. That's wages. Wages, rents, interest, profits. Oh, I double counted rents. Okay, profit, interest, rents, wages. Then households get the money, so this is money that they receive in different forms and shapes, and they spend money. Consumer spending. That's the simplest model of how the economy works, and you see here the same relationship between income and spending. Actually, you get your income from the goods and services that you produce. You use it to exchange it for final consumer goods to buy stuff. So the key takeaway from this is that incomes in a market economy include, if you want to calculate GDP, if you accept the total spending has to equal total income, then the idea is if you add up in one place all incomes that all people receive, you will get GDP. Profits, which are separated then into two subgroups. You can say proprietors' income, one of them. That means the individual owners of privately held firms, closed firms. You get the profit, you invest money, you sell something, you have a profit. It's your personal income, and also corporate profits. You buy stocks, the firm makes profit, you get the dividends, you get the payments. Corporate profits. These are incomes. Net interest payments, save money in the bank. Get your interest back. Rental income. You rent your property, whatever that might be. Somebody, you receive a compensation. That's also type of income. rental rents. Employee compensations, so those would be wages plus fringe benefits. So employee compensations. This 4 or 5, rather, if you treat corporate profits and proprietor profits as 2 distinct categories, as your textbook writers seem to do, then you have 5 components or 5 distinct forms of personal income. When you add them up, theoretically, you should get GDP. Now, you can do 2 different things here. You can say, let's calculate personal income, so let's calculate the total income for all American citizens, irrespective of the place of residence. Let's calculate all profits, rents, interests, and wages for all Americans wherever they live. What is that called? For all citizens. It's GNP, gross national product. Then how would you get to GDP by income method? You would need to subtract then from GNP minus incomes of Americans abroad. Minus Americans abroad. Plus incomes of non-Americans who are in the country. Residents of the United States, for instance. Resident aliens. Resident aliens. But there are still some small, let's say, adjustments that need to be made here. A couple of things are added typically to GDP calculated by this income method in order to get the complete, to get the most precise number. So we add also, interestingly enough, indirect business taxes. So what is that? That would be things like sales taxes and property taxes, or value-added taxes. Or let's say sales taxes would be an example of that. Why do we add indirect business taxes to the GDP statistics here? Seems kind of counterintuitive. The reason for that is that, remember, total spending has to correspond to total income. So if you have price of a good being $25 and sales taxes $3, and the total spending on that item will be $28. So then you cannot count as a total income, as the income that is received in this transaction only $25. You have to include these $3 that are paid on the tax, indirect business taxes, irrespective of the fact that these $3 are not received by the same entity that $25. Okay, it's the government gets $3, but never mind. It has to be calculated as a part of GDP because spending has to correspond to income, of course. And one more thing here has to be added. That would be depreciation. It's called capital consumption allowance. Convoluted term that means simply capital consumption means the reduction of the value of capital goods. When you're consuming capital, that means that you're doing something that reduces the value of your capital goods, of your fixed investment. For example, your machine If you're using year after year, loses its value, that's capital consumption. But then you have a tax deduction for depreciation. It's the money that you receive on the account of capital consumption, so it has to be counted as a source of income. Although it's not an income in the sense that you're buying stuff for it. You're just maintaining the existing level of production, the existing standard of living. So let's say plus depreciation. Capital consumption allowance. And there are also some smaller statistical adjustments and discrepancies that are being done. But in principle, these 5 original sources of income plus capital consumption allowance and indirect business taxes that should give you in principle GDP. GDP calculated by incomes. So this number, when you add all this up, here should be equal to consumption plus investment plus government spending plus net exports. Remember the formula from last time. These two things have to be in principle equal. Remember, this is the expenditure method of calculating GDP from last time. Consumer spending, investment spending, government spending plus net exports. Difference between export and import. Any questions thus far? Okay, now there are a couple of additional concepts of national income that are kind of related to GDP calculated by income method, but they're slightly different. There are some nuances. So one of them is something called the net domestic product. Net domestic product. That's just GDP minus this capital consumption allowance. Why would anyone want to calculate this? Why would you think maybe that NDP is a better proxy for the real standard of living than GDP? What I think. I just gave you the answer a few minutes ago. So why would you subtract capital consumption allowance from total figures in order to get this number? It's called the net domestic product. Net of what? We eliminate simply just the costs of maintaining the existing production structure. So this is not expenditure that increases our standard of living. We are not consuming more goods and services. We are not better off in any conventional sense of the word. We're just getting a kind of break from the government in order to replace our capital goods, to keep them in constant conditions, let's say. That's the reason that net domestic product is lower than GDP, because the expenditure that we have to make for maintaining the structure and quality of capital goods is eliminated. So I can say that the GDP calculated by income method without this adjustment is overinflates or overestimates the standard of living. Okay, but there are further complications. There is something called personal income now. Now this is a further reduction. So this is this minus, so national income minus a couple of things. First, undistributed profits. Corporate profits. So dividends that were not paid. I would say profit that is reinvested in production is not counted as a part of income. So technically it is, and it's the corporate profit, but if it's not paid to the final stockholders, it's subtracted from the gross figures. Another thing is also social insurance taxes. We subtract that as well. Why is that? Because social insurance taxes are not part of market transactions. You don't have to add them as you have the business taxes. Remember this, social transfers are not part of GDP on the spending side. Why? Because they're not compensations for goods and services. On the spending side, when you look at the transaction, only those transactions that compensate actual goods and services that are being offered in exchange, they're part of GDP. So government purchases of office material or paying of wages and buying the materials for paving the roads are part of GDP, but social security checks are not part of GDP. So then the taxes, when you look from the income side, and the taxes for social security should not be added to the incomes in the same way that the business taxes should. But we add something here. Now you count social security transfers, social transfers or transfer payments. Yeah. Transfer payments. Why do we include here transfer payments? Because they are part of your income. Actually, that's money that you receive that you can spend. So when you calculate the GDP via income method, then you include, of course, social security payments and Medicare reimbursements and so on. So that's personal income. You can think of it as the total amount of money, total amount of spending power that people receive, that people actually receive. So that would be these five here: profits, interest payments, all that. Minus depreciation, minus capital allowance, capital consumption allowance, minus this thing, minus that thing, and plus transfer payments. And that's personal income. Individuals receive it. Every individual receives it. Society as a whole. That's the structure of income that enters into calculations of GDP. Typical five types of factor incomes: minus depreciation, minus undistributed corporate profits, minus social insurance taxes, plus transfer payments. Okay, and that's not the end. Now, there is one more. Here, that's disposable income. So what is disposable income? That's personal income minus individual taxes that you have to pay. Primarily income taxes. You say this is a gross personal income. Before taxation, this is after taxation. Disposable income is the net personal. Whatever is left once you pay income taxes. No. Or different way of defining it would be the total amount of income that is available after taxation for spending and saving, or consumption and saving / investment. That's disposable income that you can dispose with. Eventually, all individuals can dispose. So that would be personal income minus personal taxes. So now, what is the advantage of this method, or what is the employment of this method of calculating GDP? It is much more convenient for the purposes of social policy, redistribution and cost, and so on. You can see what is the individual distribution of income, how much money individuals have, and what are the results of different policies that you pursue. So you can account for individual distributional effects of economic policy. Thing that you cannot do with the expenditure method, which is just calculate those gross macro aggregate spending, consumption, investment, government spending, and so on. That method is primarily good for the purposes of macroeconomic policy, the business side of policy. This method is better for social policy, the distribution, and so on. You can track the effects of your policy for individuals. Okay, any questions? That's one. Okay, so this should be pretty straightforward. It's just a series of formulae, basic definitions, nothing particularly complex about it. Now, the next thing that I would like to share with you is real GDP versus nominal GDP, number 2 here. Versus real GDP. So remember our simple example that we can think of an economy or a GDP as just a collection of 3 goods, A, B, C, and then you calculate the total GDP for this economy by multiplying the quantity, the number of units of all 3 goods multiplied by prices. So let's say 20 units times 2.5, 15 units times 3 gold, and 40 units times 4 gold. So then your total value would be 160 and 45, 205. And what is this? 45, 250 gold would be value of GDP in this economy. And now, if we assume that GDP measures wealth and standard of living, higher the GDP, the better, then we can face pretty awkward situations here. For example, none of the quantities produced increased. Let's say next year, we are tracking the same economy, and the quantity of goods, A, B, C, that are produced are exactly the same as they were last year. But then the prices of B and C increased to 3.5 and to 5. What's going to happen to GDP? If you don't do anything to adjust it, it's going to go up. So now the nominal GDP will be whatever, let's say $270 or something like that, as a consequence of this price increase. But would you say that those people who consume A, B, and C are better off than they were before? Only because their nominal GDP is higher? No. What they're interested in is the quantity and the availability of real goods and services that their income can buy. So one of the problems with GDP statistics is that the nominal changes in GDP don't tell you whether the change up or down was caused by an increase in price, by an increase in quantity. Also imagine that the prices remain the same and quantities of B and C increased. You will get the same number, 270, which is caused by higher quantity of goods and services being produced at the same price level. Or you can have an increase in both productivity and prices. So now, in order to understand what changed in an economy, how much the standard of living increased or decreased, you have to dissociate, to somehow disentangle the influence of the price changes from the influences of physical productivity changes. To control for a price change, in other words, to reduce the talk about nominal GDP to talk about quantities of goods and services that are produced. How is this done? This is done by the adjusting nominal GDP to real GDP figures. So this is the formula that we use, sigma sum of all prices times quantities that are produced in any given country. So then what would be the real GDP? This is in the nominal GDP figure. This is current prices times current quantities every single year. So for year 2019, you calculate the nominal GDP by multiplying prices for 2019 with the quantities of goods and services produced in 2019. Okay, that's nominal. For 2020. You get the nominal GDP by multiplying prices for every individual item in 2020 times quantities of goods and services produced in 2020, and so on down the line. Real GDP, you do a simple trick. You select a baseline year, let's say 1975. And then you say, I'm going to look at what happened with the production every single year, but I'm going to keep constant prices at baseline year. I'm going to be multiplying the number of units that are produced every single year with a constant 1975 prices. I pull up statistics from 1975 and say, this was the structure of prices for those goods and services in 1975. Now, when I'm calculating GDP for 2018, what I do, I multiply real GDP for 2018 equals prices for 1975 for every single individual item, let's say A, B, and C, whatever the prices were at the baseline year, times quantities in 2018. Okay, how many units were produced in current year? Real GDP for 2018 equals prices in 1975, if this is the baseline year, times quantities in 2018. So now it's an apples and apples comparison. Whichever year that you choose, the only factor that influences the final number is still in dollar terms. It's the price in dollars times quantity. It's just not the price in current year, it's the price in the baseline year. So then you succeeded actually in disentangling the effects of price changes from the effects of changes in production by simply arbitrarily assigning to every single year the same constant prices of 1975. And then the only factor that influences your GDP figures is physical productivity, how many goods and services are produced. Okay? So that's the reason why sometimes people say, oh, this is $2,000 in constant dollars. What people mean by this is actually that you take one baseline year in 1900, and then you recalculate the present nominal incomes of $100,000. How much is that in? How much would that be worth in 1900? How many goods and services you could have bought for? or the equivalent of that money. So then if you have an increased level of prices, this method will deflate your GDP numbers. So if you say, for example, that the prices in 1975 were 2.5, 3, 4, and 5, 6, and 11 in 2018, then your nominal income, your nominal GDP would have increased more than double. But what happened to your real GDP? If your production of A, B, and C hasn't changed, your real GDP will remain wherever it was. So, I'm telling you this just to prepare the ground for the next piece of information, is actually that when we talk about GDP and recessions and changes and economic growth, long-term economic growth, or short-term fluctuations in business activity, we're always using real GDPs in business, never nominal GDPs in business. Because we're interested, after all, in how well an economy is doing, not what is the nominal dollar value of goods and services, but what is the real, how much real goods and services people can buy their money. When we say that the economy is growing, that means that production is growing. It doesn't mean that when we multiply prices in production, we get higher number. What we mean is actually when we control for the price changes, the quantities of goods and services increase. One more adjustment that is necessary. Now we are preparing the ground to understand what kind of GDP statistics is used for business cycle analysis, recessions and expansions and booms. It's a real GDP with one additional twist, population adjustment. So what does that mean? That means if population increases 5% between different years, it's not enough to calculate just GDP daily. But it has to be divided by a larger number of people. So then GDP per capita is much more precise measure of standard of living, real GDP per capita. That's the best statistical measure of standard of living. Real GDP corrected in this way, then divided by population. Or you can do another thing. You can take total real GDP, and then you look from 1995, for example, to 2018, how much population increased. So then you deflate the current GDP by the increasing population. You adjust downward the real GDP. Because you have the same, let's say if we had the same real GDP 2021 as in 2018. We would still be worse off because there were fewer Americans in 2018 than 2020. So then the same quantity of goods and services in 2021 is worse. Our standard of living is worse because there's more people. So then you have to adjust the real GDP figures downward to account for the percentage in which the population increased. You have to reduce real GDP. Okay, so those are just nuances that you bear them in mind, but we're gonna just ignore them. We're gonna assume that when we talk about real GDP. Okay, now what about recessions? So that's the final thing for today. Or business cycle definitions that I promised. So we already know this at the intuitive level, and I told you pretty much all the crucial elements of this definition. But you have two phases of the business cycle: expansion and let's say, downturn. So let's say that this is on the vertical axis, it's the horizontal axis is time. Here is delta growth rate, change in the growth rate. Let's say that this is 0 growth rate. This is greater than 0, down here is smaller than 0. Let's say this is the growth curve. Goes up to here, let's say here is 4%. This is growth rate in percentage points. Peaks here, and then starts going down. Bottoms out here, and starts increasing once again. And peaks, let's say here, and then starts going down. So this point in the current business cycle, and the economy is growing every next year, let's say, or every next quarter, this is time. Horizontal axis is time. The evolution of economic growth, short-term economic growth over time. This point here is called peak. That's a point where the rate of real GDP growth is highest. That's 4%. And then it starts slowing down. So this part of the curve, from peak until it reaches 0%. It's called downturn. That means that the rate of economic growth is still positive. It's still higher than 0, but it's declining. It's slowing down. It's lower and lower. Every subsequent period of time, it's lower than before. Once it crosses this 0 line and stays there for, let's say, 2 consecutive terms, remember that definition. We talk about recession. Recession is a period when the real GDP, population adjusted real GDP growth, is negative, less than 0, for more than 2, or for at least 2 consecutive quarters, or 6 months in a row. Technically, we define. There's no scientific reason why that's the convention. That's Labor Department defines recession technically that way. Now, this lowest point here, let's say minus 3% growth rate, so decline 3%, is called through. That's the lowest point of the business cycle, through. That's the economy's through. It's the bottom point. The economy bottomed out, and now it starts growing once again. But it starts, at first, it doesn't actually grow. It's just the rate of decline is declining. Just as here, it didn't enter into recession right away. From 4 points, it didn't go into recession right away, but it went to 3%, 2.5%, to 1.5%, and so on. By the same token, here, when it reaches minus 3% and starts going upwards, it doesn't go out of recession right away, but the recovery starts. This portion of the growth curve is called recovery. That simply means that economic growth is still negative, but it's improving. Once it crosses this line of 0% for at least 2 quarters and goes in this area, this is called expansion. Now the rate of economic growth of real GDP growth is positive. The economy is expanding once again. So this entire portion of the growth curve here is recession. So recession has 2 components essentially. It has this decline from 0 to through, from 0 to bottom. That's the first part of the recessionary segment of the growth curve. And the second part of the same curve is this recovery phase. Interesting enough. Recovery when the economy starts getting better, in a sense, but still not good enough to grow actually more than 0%. So technically, you are still in a recession here, just as you're in a recession there. Okay? So this is a recession. This is a period when the economy is out of recession. And it grows and grows and grows for a while, and it reaches a new peak here. And after this new peak, it starts declining. So this period between peak to peak is called business cycle. Yes. So here, peak 1, peak 2, you have the first initial expansion that peaks. The initial peak, this is expansion. You have the downturn from peak to 0. You have recessionary decline from 0 to through, from 0 to bottom. You have recessionary recovery. It sounds weird and ridiculous, but that's the best term back in the economics. Beginning of the recovery that is still technically within recession, and then you have a further recovery which is expansionary, that the economy is now expanding or growing once again. So just the final graph here to show you how what this looks like if you try to pair together growth rate and time. And let's say you do the short-term curve over time. Short-term economic growth. That means that you increase the resolution for maybe 1 year or 6 months and look, what does it look, this graph over a period of 100 years. You get something like this. So these would be recessions, here recession, 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 expansion, 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 peak, 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 through, okay? So you see, it's a ratchet up structure. It's not like a fluctuation along a flat curve that doesn't change. It's growth. So if you were to draw a straight line, a linear function, long-term economic growth, you will get something like this. Because it smooths out those short-term fluctuations. This is a long-term curve. This is just 3% per year American growth rate in the 20th century. But it doesn't mean that every single year the economy is growing at a steady rate of 3%. It means that when you average out everything, you get 3%. And that's, I don't need to remind you once again that this is the main puzzle that we will be losing our sleep over the rest of the semester. Why on earth is this looks like that? There's no reason like that. And still it does. Still it does. And 5, 6 years, and you get into a recession. 8 years you get into a recession, and 3 years after that into a recession. There is no, people tried all they could to figure out some empirical regularity. How many years? Is there any algorithm? Is there any mathematical rule that you can calculate and predict when the next recession is going to hit? No results whatsoever. Every single recession in the last 100 years is different time period, different degree of decline of national income, different characteristics of recovery, different government policies, nothing. There's no way to look at the data and understand anything about the cause of relationships, what causes recessions, what to do about them. So we'll try our best to see what economists think about this later on. But this is just preparing the ground of what do we mean by recessions and how we do know that recessions are happening. Any final questions, please? No. Have a nice weekend, survive the cold. Although I probably don't need to tell you that tough day. And I'll see you all on Monday, except if there are people from California or Arizona. Okay, see you. Have a nice weekend. See you all on Monday. Again.
There's going
You too.
Thank you. So, everybody signed the attendance.
people making these predictions that nobody's ever actually.
Thank you.